Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. The stock market has been really volatile this year, and that is because of concerns related to inflation and rising interest rates. And over the past few days, headlines from Europe have further unnerved investors. So obviously, investors are looking for products that allow them to participate when the market rallies while providing some downside protection. And there are many products available in the market. There are many ways to, try and protect on the downside. But remember, there is no perfect solution because a perfect solution is just too good to be true. There's a lot of interest in buffered ETFs lately, and we have done a couple of episodes in the past on buffered strategies. Today, we are focusing on two other very interesting and very innovative strategies for hedging. My first guest is Paul Kim, CEO and co-founder of Simplify. Simplify has a suite of ETFs that help investors hedge against key risks using options. And their lineup includes ETFs that provide exposure to broad indexes while using options for downside protection. And they also have some ETFs that investors can use to build a core fixed income portfolio while managing credit risks. And they also have some thematic ETFs. So Paul and I will talk about all those strategies and how they can be used in a portfolio. In the second part, I'll be joined by Bill DeRoche, Chief Investment Officer at AGF. AGF has a couple of very interesting long-short ETFs. And these long-short ETFs have significantly outperformed the market this year. So we'll talk about those strategies and how exactly they work and how they should be used in the portfolio. Joining me now is Paul Kim. Paul, welcome. Great to have you on the show.
Thank you, Nina. Welcome this opportunity to talk and looking forward to it.
So to start off, tell us a little bit about Simplify. And I know that this is a new ETF shop and you have been pretty successful. You launched your first 3 ETFs in September of 2020. That's just a little over a year back. And now you already have 21 ETFs with about 1.2 billion in assets. So tell us about your company and congratulations on the success.
Thank you so much. Yes, we're a relatively young shop, although I would say most of our my colleagues are experienced. Myself, I'm experienced as well in the ETF world. This is my third ETF lineup or product offering. I was at PIMCO, where I helped build out their ETF business. Same at Principal, and then now Simplify is my third attempt at making an impact in the ETF industry. It's been a really fun early ride so far, and really the reason it's so fun is because we get to interact a lot with our main clients, which are typically advisors, especially RIAs. And really, we're helping them address some of the largest portfolio problems. And these days, a lot of those problems are hedging or addressing portfolio risk at a time where it's really hard to find good sources of diversification like bonds have been in the past. And so I think problem solving and addressing these type of things, which by the way give a lot of good reason to launch new products because there's a lot of problems out there. That's really been the fun early ride we've had so far.
Yeah, you're right. There's no shortage of problems for investors in this market scenario. And looking at your lineup, all these ETFs use options-based strategies. So why these options-based strategies? Could you give us a high-level overview of what these options-based strategies are, and maybe also explain convexity to our listeners who are not very much familiar with options-based strategies?
Sure. So options, if you think about options, you could either think of them as they are derivatives, but often that word is mixed. I think people worry about derivatives and sort of how difficult they may be to understand. But at the same time, derivatives are a tool, and so they help people with very specific sort of exposures, and really can be very useful when it comes to hedging or protecting portfolios or limiting risks. The reason options are so interesting to me and to a lot of our clients is because they have the benefit, while they cost a certain amount of money, you have a certain range of outcomes, and often options have where if you buy an option, the most you could lose is the amount or the premium that you spent on an option, but many options have unlimited potential gains. And so that's a very interesting trade-off, right? So limited downside to what you've spent on the option with unlimited upside if you get the direction of your call correctly. And so I think that presents a very interesting way to create novel or interesting exposures in a portfolio. If you're worried about a certain amount of drawdown in your portfolio, well, you could protect that. You buy an option that cuts off that type of exposure. Or if you want to add a little bit more upside, if you think a certain stock or industry is going to do well, options allow you to sort of take that view. And so options are just tools, and they're very interesting tools. And when it comes to protecting portfolios, they have the positive benefit of being able to add convexity. It's a scary sounding word, but convexity in the simplest terms means you could lose less than you could make. And so again, the same concept of buying a option for a certain amount, knowing that that's the most you could lose with that option, and having a much larger payoff. But they're tricky to use. And again, I think the value that Simplify has been bringing is to combine the power of options while balancing the complexity and the cost of using options as well.
Very interesting. Now, you have some ETF strategies that allow investors to have exposure to broader indexes like the S&P 500 or the Nasdaq or the small cap index, and at the same time having some downside protection, including your most popular and one of the first ETFs from Simplify, which is SPD, which provides exposure to US large cap stocks. So talk to us about these strategies and how they should be used by investors in the current market scenario when everyone is worried about, inflation and rising rates and geopolitical tensions, etc.
Yeah, and look, these U.S. large caps broadly, equities in general, have done very well for investors, right? It's kept up and surpassed inflation. It's generated very strong returns and has significantly improved people's retirement portfolios. The problem is we're in a macro environment where elevations are high, risks of recession and geopolitical risks are increasing, and then sort of your ability to manage that risk in a portfolio has gone down because traditionally investors have relied on bonds, for example, to protect the portfolio when everything is sort of volatile and scary. But in today's market, bonds themselves are risky, right? So if you have rising inflation and rising interest rates or widening credit spreads as the market sort of starts tipping towards recession, bonds all of a sudden also seem very much priced to perfection. And so we view options inside of portfolios, especially when combined with equities, as a really interesting way to add portfolio diversification to help really mitigate downside risk but while also allowing people to stay invested. And that's really the trade-off, is how much upside do you want to retain? How invested do you want to be versus what does it cost to manage risk, right? Anyone could manage risk. If you want zero risk, go buy T-bills, go stick all your money in a money market fund, and you're going to have no risk. But unfortunately, that also typically means you have really no return. And so everything is a trade-off. And I think what our lineup of ETFs allows or provides is more choice on that trade-off. So do you want to be 100% equities? Fine. There's great passive ETFs out there or index funds that have done very well. Do you want to be a little bit less invested and more risk focused? Well, now we're offering some intermediate options there, from, again, going from zero risk of money market funds all the way to sort of the 100% equity risk that people have also used.
Yeah, could you talk a little bit about the two ETFs that provide exposure to the S&P
Sure.
500 index and the Nasdaq, SPD and QQD? Because many of our listeners, they have these ETFs at the S&P 500 ETF and the Nasdaq 100 ETF in their core portfolios, and they are now wondering whether they can use some strategies that maybe can be used to hedge their exposure.
So this is a great follow-up to my previous answer. And so let's take our ETF SPD, for example. And SPD basically invests almost all of its portfolio in a passive US large cap. It buys iShares IVV, which is a S&P 500 index ETF. And then it takes a couple percent a year and basically buys insurance. So it's buying downside protection by buying puts on the S&P 500 or S&P 500 index. And what that modest amount of budget in terms of insurance does is that if the market sells off significantly, think of a March 2020 or back in 2008, those type of drawdowns can be largely sort of mitigated, or at the minimum do better than having no protection, and in a meaningful way. And so by cutting off some of these significant drawdowns, it allows investors to actually stay invested and drive some solid returns without worrying about again, those massively extreme events, tail events. But that's a trade-off. You could either perfectly hedge equity risk and start removing all the return, or in our view, focus on the tails, the stuff that happens once every 8 to 10 years. If you sort of try to cut or mitigate those events and try to stay invested otherwise, we think that's sort of really interesting combination that may improve geometric returns, i.e. your long-term returns. And most of all, you don't have to rely on the sort of help of options or help of bonds or some other asset class. So that's one example. Generally get S&P or large cap returns with a modest drag from insurance. The other is if you look at our sort of much more defensive equity strategy, it's HEQT, our hedged equity ETF. And what that strategy does is say, look, I'm not interested in a home run every year. If the S&P or the US large cap in this market returns double digits, I don't need to get all that upside. I want to get some of that upside, but in exchange, I want to really address the downside. So I don't want to lose more than 5 or 10% in a quarter. I'm willing to pay up for that. And so that combination of much more defense in exchange for some of the upside is sort of an intermediate step. It's just moving further down the risk spectrum. So that's an interesting thing. And then anything you could do with large caps, you could do in other exposures. And so we offer similar downside strategies for the Nasdaq 100, which is a great growth portfolio that has done very well given all the technology names in there. We also offer strategies in small caps, developed market, and EM. So anywhere you have a very interesting and popular equity exposure that has options on it, we are able to build a strategy to play some defense.
Very interesting. Now, yesterday you launched two new ETFs, and these ETFs provide exposure to investment grade bonds and high yield bonds. Yep. And you talked about rising risks in the fixed income market. So tell us a little bit about these two new ETFs and why investors should consider them now.
Sure. So bonds have been almost in the perfect sort of environment for the last, call it almost 4 decades, right? We've had falling interest rates, which means that bonds have driven solid income, right? Capital appreciation as interest rates have fallen, those prices of the bonds have gone up, and they've also benefited by providing portfolio diversification. So bonds tend to do well when equities are struggling. And so they've been this perfect sort of portfolio diversifier. But in today's world, that's no longer taken for granted. Rates have stopped largely dropping, and they're starting to pick up with inflation. Credit risk is back on everyone's sort of radar. And so I think all the things that have helped so much in the past 40 years is starting to shift. And so we want to be able to create a solution that allows people to get some of the main benefits that they've come to rely on from bonds, i.e. income, portfolio diversification, and sort of ballast for portfolios, but something that works when some of those tailwinds that we've seen start turning around. And so we are offering two new ETFs. CDX is basically US high yield bonds that we then put a credit hedge on. So if companies start defaulting and credit spreads start widening, this ETF should still do better than just unhedged high yield exposure, yet it still retains the income potential that people have gotten used to from high yield. So in today's high yield market, that's 4 or 5% is sort of like a broad passive high yield ETF, and we're able to basically deliver that plus a credit overlay on top. And so I think that's an interesting thing where you could sort of benefit from most of the positives of fixed income, but also try to mitigate some of the biggest negatives, i.e. the credit risk.
So tell us how these hedging ETFs should be used in an investor's portfolio. Of course, the first question that investors face, which you also alluded to, is whether they should hedge at all, because there are always costs involved and there is no perfect solution. So if investors decide to hedge their portfolio, tell us how these strategies should be used in a portfolio.
Sure. And I think it comes back to the benefits of diversification. So if one takes an approach that they want to diversify their portfolio so that you have both risk assets that deliver returns in many years, but you also have things like bonds that protect the portfolio, and the combination generates a very attractive, less volatile return. I think that approach works the same exact way if you're going to go and try to hedge using options or other derivatives. It basically says, okay, I'm willing to invest some of my returns every year to play some defense and protect some of the downside of my portfolio. And in exchange, it smooths out the ride. And also when market sells off severely, it actually provides dry powder, right? So your hedges make money when the markets become much more volatile, and that earned hedge return then can be used to go buy risk assets, stocks, and high yield and other things at lower prices. And so that sort of value proposition, if one buys into that, I think it's a more favorable reason to hedge. And if you're going to hedge in today's market where all of these sort of traditional risk diversifiers, again, think of bonds at their current rates, are not as effective as they used to be in history, I think options become a very, very interesting diversifier of your diversifiers. So don't just rely on one thing to protect your portfolio. Think about different ways to protect. And the one major benefit that an option has over things like bonds is that an option is explicitly tied to the risk assets. If you buy a put on the S&P 500, it will pay off when the S&P 500 sells off. Like it's just linked to the price of the S&P or the level of the S&P. Whereas bonds, you're relying on history to tell you that bonds go up when stocks fall, but that's taking that for granted because there's been decades where both bonds and stocks move in the same direction. So bonds are selling off at the same time that stocks are selling off. And so I think the idea that you want to protect and hedge your portfolio in a reasonable way so you still have meaningful upside, but hedge in multiple ways so that you're not relying on just one way to protect your portfolio, that's probably a decent approach or mindset to navigate today's world, because it is much more complicated and it's much harder to find attractive ways to protect portfolios today. Things are just very, very elevated in terms of risks and concern.
That makes a lot of sense. Now, switching gears a little bit, I also want to briefly discuss your thematic ETFs. And you have a very interesting suite. You offer the FinTech ETF, VFin, Cloud and Cybersecurity ETF, VCLO, and Pop Culture ETF, VPOP, and there's a RoboCar Disruption ETF, VCAR. So all these strategies, disruptive strategies, they did pretty well in 2020 because they benefited from the pandemic-driven trends, but last year was not a good year for them. And many of these stocks, these high-flying stock, disruptive strategies and
especially
stocks,
November, right? November onwards.
Yes. So they have taken a beating over the past several months. So if you were to pick one thematic ETF out of these for 2022, which one would you pick and why?
Of these four, the largest and most successful and probably the best prospects based on, again, what clients are looking at is probably the cloud one. I think that's a very secular and long sort of live theme. We all sort of interact with Amazon and all these sort of cloud-based businesses, certainly on the business side, but individuals, a lot of the infrastructure of all of the e-commerce and sort of streaming companies are on these businesses as well. And so I don't see that slowing down anytime soon. And some of the names in these in this ETF are poised to really capture that upside of that continued growth as technology continues to develop and disrupt the way we work and the way we live. So I think that's a pretty interesting and long-lived sort of exposure. And I think it's done very well since inception relative to both peers and just absolute. And the whole idea behind these thematic ETFs that we offer is also convexity, but convexity goes up or down. So we talked a lot about hedging, but also convexity works when you buy something like calls or you buy things that could go up a lot relative to the cost of the call. And that's what we're trying to do. We're trying to look for companies that are tied to really interesting big picture trends and try to identify a handful of winners within that trend, and then not just concentrating in those winners, but also buying some long dated calls on them so that if these winners continue to win market share and go up in value, not only does this ETF win as their prices go up, it wins because you have call options, the right to buy more shares at higher prices. And so it moves up relatively quickly compared to less concentrated or thematic ETFs that don't have call options inside of them.
Very interesting. I agree with you on cloud computing. Of course, the pandemic accelerated the move to the cloud, but this is a trend which should continue to accelerate because, we know that cloud computing is more secure, more cheaper. And this also gives companies a lot of flexibility and agility in scaling up or down their operations. And we saw from the results of major cloud providers, including Amazon that you mentioned, Microsoft and Google, all their cloud businesses did so well. So I also see a very good future for cloud computing ETFs, and your ETF with the option overlay is definitely very, very interesting strategy and definitely worth a look. And that's all we have time for. Paul, thank you so much for joining us.
Well, thank you so much, Nina. Really enjoyed this, and thank you for the time to sort of describe our strategies and our business.
So that was Paul Kim of Simplify ETFs. You can visit their website, simplify.us, if you want to learn more about these strategies. And I'll now be joined by Bill DeRoche, CIO of AGF Investments. Bill, welcome. Great to have you on the show.
Thank you very much, Nina. It's a pleasure to be here.
So tell us a little bit about AGF.
So AGF is a Toronto-based asset management firm. It's been around since 1957. They do have offices outside of Canada. I actually work in the Boston office for AGF. Primarily, they've focused historically on fundamental type analysis in mutual funds. More recently, they've expanded now into other vehicles such as ETFs and separately managed accounts. They've also added quantitative capabilities. Those quantitative capabilities are branded under the AGFiQ brand, and that's actually the area that I work in.
Great. So this year has been very volatile for the stock market, and I was interested in your thoughts on the recent market action, the seesaw activity that we have seen so far.
I think we've all figured out that, inflation is running much higher than everybody had anticipated. And if you look at expectations now, most firms are calling for significant rate hikes through 2022 and 2023. We're hearing as many as 7 rate hikes. The idea here, obviously, is to slow things down a little bit to combat that inflation. From our perspective, I'd say, if we were to deviate somewhat from that consensus, we would suggest that there probably is fewer rate hikes coming, but still quite a few. More importantly, we would suggest that the Fed is also going to use its tool in terms of its balance sheet, since it's severely bloated at this point. And by using both rate hikes and quantitative tightening on that balance sheet, we feel as though they'll have a better chance of, keeping the yield curve steep so it doesn't invert, and thus, preventing, say, an economic recession. So because they've said that they are going to be, very data dependent moving forward, for me, that's just another way of saying that there's still an awful lot of uncertainty. This is something new in terms of trying to undo all the excess that's been put into the system because of the pandemic. And as a result, because of those statements, there is significantly more uncertainty than we've seen in the past. And as a result, our view is you're going to see a lot more volatility than we're used to.
Okay, so how should investors navigate this heightened volatility, and how should they position their portfolios for the rest of this year?
Yeah, so as we look at the market, we're still constructive on equities, even though the Fed is tightening, the economy is in good shape, companies are doing well. We just kind of went through an earnings cycle here. So the view is that things are still positive from that perspective with regards to that. But you have to be concerned as we go into that tightening cycle. The Fed's mandate obviously is dual in terms of full employment and controlling inflation. So you have to be concerned that if they're too focused on the inflation aspect that they could end up basically slowing the economy too much and leading to a recession, which means you have to worry about your equity exposure. So, obviously the term TINA has become popular over the last couple of years in terms of there is no alternative to equities. And if you look at, say, fixed income, just more broadly, with rates going higher, you have to be concerned that your fixed income portfolio will suffer. So, one of the big things that we look at, and historically people have used fixed income as a hedge for their equity portfolio. And the reason for that is typically if equities are going to head down, it's because the concern is global growth is slowing. And as a result, the typical response from central banks is to lower interest rates. So, if you look at that, say back in, say, March of 2020, when the Fed dramatically dropped rates, if you were, say, long duration treasuries, you had a significant hedge to the, equity portfolio that dropped dramatically due to the pandemic. The problem now is if you look, say, back in January, you had the equity market go down, a fair amount to start the year off, but you also had long treasuries down a lot also. So this is like the first time in quite some time that those long treasuries have not been a good hedge for your equity exposure. So, we're cautioning clients who've grown accustomed to using treasuries as an equity hedge to look in other directions. We have a nice product that can fit that niche. It's more of an insurance product. It's designed to zig when the market zags. It's basically a product that has both long and short positions in it. So it's a little bit different, but it's something that's definitely been gaining some traction as people look at this particular market cycle and recognize that it is a little bit different than what we've seen, say, over the past, 5 to 10 years.
Yeah, you're right. Normally, investors seek refuge in safe haven assets like treasuries when markets are volatile. But in the rising interest rate scenario, treasuries themselves become very risky. Now, you mentioned your product. Let's talk about that. And I noticed that it has done pretty well this year. It has a positive return, whereas the major indexes are down 7, 8, 10% this year. So this is AGFiQ, market neutral anti-beta fund. The ticker symbol is BTAL. And as you mentioned, it's a long short ETF. It holds long positions in low beta stocks, and those long positions are offset by short positions in high beta stocks. Tell us a little bit more about this strategy. How exactly are these stocks selected, and how is the weighting done?
So the product that historically has been index-based. It tracks an index published by S&P Dow Jones. We can talk about some of the changes around that. But the idea is that it's trying to pick up an anomaly that exists between low beta stocks and high beta stocks in terms of an asymmetry. And as you mentioned, the long portfolio is long low beta securities. It's within sector. So the initial universe always starts with 1,000 securities. The Dow Jones US universe is the initial universe. There's about 1,400 names in that. We whittle it down so that we always start with 1,000. And then each of the long and short portfolios will end up with 200 names. It's based on the counts within each sector. So if there's, say, 100 names within technology, we'll end up with 20 names in the long portfolio. And those will be the 20 technology names with the lowest betas. And we'll also end up with 20 names in the short portfolio. And those will be the 20 names with the highest betas within that technology sector. On the reconstitution and rebalance day, which happens on a quarterly basis at the end of February, May, August, and November, the portfolio will be positioned so that each position is equally weighted, so that those 20 names will be 50 basis points each. we'll have a 10% exposure in the long portfolio to technology and a minus 10% exposure to technology in the short portfolio. The idea is to make sure that we're not having huge sector bets. You could imagine if we just did like low beta, we'd end up with quite a few, say, utilities names. And if we just did high beta without doing it within sector, we'd end up with quite a few financials. So those are the index rules that the portfolio uses to create the methodology. The equal weighting idea is to make sure we get exposure to the anomaly, which is low beta versus high beta, without any one name actually over-influencing the actual return of the portfolio.
It's a very interesting strategy, and we have seen investors have pivoted towards these earlier boring, cheap stocks, which are low beta stocks, and they have sold off their high beta, earlier high flying stocks, which did particularly well in 2020 and early 2021. So that is why this strategy has done quite well. I saw that the expense ratio is quite high at about 2.5%. So tell us why the fee is high for the ETF?
Yeah, so it's unfortunate, but it's one of the rules the SEC requires with funds that short. And you could look at any ETF that has short positions. HDGE might be a good example to see. But when you're short a security that pays a dividend, you have to actually pay that dividend out of the fund since it's a cash outlay. The SEC classifies that as an expense. That dividend payout is actually part of the index. So if you look at the fund's tracking of its underlying index, last year it tracked within 65 basis points of the index return. 45 of that would be due to the management fee. That's always going to be there. And the remaining 20 in this case was mainly due to transaction cost, which is basically trading the portfolio, so it tracks the index on those quarterly rebalances. So it is confusing for investors and unfortunate, but any fund that has short positions is going to have to classify the payment that occurs for equities that are short due to dividend payments as an expense in the fund.
That makes sense. So do you expect this outperformance of low beta stocks to continue going forward too? And could you also talk about some of the holdings in the ETF, both on the long and short sides?
Yeah, so when we look at various regimes, and when we think about the economy, we think of, regimes where real rates are falling and inflation is falling. We look at regimes where real rates are climbing, inflation is climbing. So when we look at this particular environment, the expectation is that real rates are going to continue to climb. The Fed has pretty much made it clear that they are going into a tightening cycle. If we look at real interest rates in the U.S., looking at the TIPS market, you can see that real rates bottomed, and they were fairly negative if you just look at the 10-year rate back in like the first or second week of November of last year. Since that point, they've been steadily moving upwards. If we look at inflation break-evens, the same thing there is just the opposite in that they basically are peaking about now. So the expectation is that, inflation is, from a break-even perspective, is probably, close to approaching its peak. So from our perspective, what that means is long duration assets, because of the higher real rates, have had some pretty significant underperformance. Most people, when they think of long duration, the first thing that comes to mind is long duration treasuries. You can look at, say, TLT in the ETF market, which is the long duration, long dated US Treasury ETF. And you can see, since the first of the year, it's been down, almost 9%. But there's also the concept of long duration equity, which is basically equities that tend to have cash flows that are, more distant out in the future. And that coincides with our definition of beta. The higher volatility names tend to be names that would be classified as higher duration equity. And as a result, the fund has generated that outperformance mainly because those high duration, high beta short portfolio has significantly underperformed that lower duration, low beta portfolio that we're long. And the view is that we can see that continue. Now, obviously, the fund does its absolute best in terms of absolute performance when the market sells off because it's long, low beta and short, high beta in equal dollar amounts. The fund does have a consistent negative beta. As I mentioned, it is an insurance product. So when the market goes down a fair amount, and we look at the up capture ratio versus the down capture ratio, if the market's down, say, 10% in a month, you can expect the fund to be up almost 8%. So that's when it's going to do its best. And that's why we think it's an important component in terms of having it to hedge that equity exposure. Equities they're the best way for folks to generate and accumulate wealth. But at the same time, once a decade or so, they'll have that significant drawdown event. And you definitely do want to hedge some of that left tail risk. So we think this is a good way to do it. And in this particular environment, when rates are going up, we would suggest people consider this versus, say, the alternative of having longer duration treasuries as that hedge to their equity portfolio.
You have another strategy, another long short strategy, and that focuses on dividend paying stocks. And the ticker symbol is Diva, very easy to remember. This tracks an equal weighted index and it goes long the high yielding dividend stocks and shorts low yielding stocks. This is a small product. Its small fund has about 5 million in assets, hasn't seen much interest from investors so far, but this year there's a lot of interest in dividend paying securities and dividend ETFs because these dividend ETFs with a nice yield, they are expected to outperform in the current environment. So talk to us about this ETF and what exactly it does.
You hit on a lot of great points with regards to the fund. Initially, conceptually, the idea was to create something that had, significant liquidity by using equity securities to mimic the risk return profile of an investment grade corporate bond fund. And the way we did that was basically to create a long portfolio of 100 securities that were the highest paying dividend payers within each sector. So we're not focused on any one sector. There are caps. And then basically create a short portfolio of approximately 200 names. And the idea is this is just a risk control part of the portfolio. And these are stocks that don't pay dividends. And again, mimicking the sector exposure of the long portfolio. And the idea is that the shorts are just there to reduce the overall volatility of the portfolio. So we don't nearly have as much equity vol as we would if we were just 100% long. So you're going to have a lot less volatility. Obviously, you're going to reduce the return in terms of the capital appreciation sum. But because you've basically focused on dividend payers in the long portfolio and non-dividend payers on the short portfolio, you're going to maintain that dividend yield that you would be expecting to generate. What we've seen, and I think you'll see the product repositioned in the coming year or two, is that people really aren't ready to use equities as a proxy for fixed income. Because the idea was that it was designed to have a volatility that's similar to an fixed income corporate bond portfolio, but doing it with equities. I just think that people found that a little bit hard to understand. So as you said, the assets in that fund are very small.
Good stuff. And that's all we have time for. Bill, thank you so much for joining us.
Oh, Nina, thank you. Really enjoyed the opportunity to talk with y'all, and I look forward to seeing you again sometime.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.